$4,361.3 US. Just this morning, London gold hit a new all-time high, but is this the peak or the start of a rally? It rose 28% last year and surged another 52% this year. Gold has become the craziest asset in the world. Goldman Sachs is calling for $4,900 US, while State Street Bank warns it could fall back to $2,200 US. Is entering the market now a chance to profit or a trap? The answer lies in three key codes. The first code is in the Fed's meeting room. In the early morning of October 21st, the Federal Reserve just announced a 25 basis point interest rate cut, lowering the rate to 4.00 to 4.25%. More importantly, 9 out of 19 officials support another 75 basis point cut within the year, equivalent to 3 rate cuts. This is not groundless. In May, the U.S. CPI rose only 2.4% year-on-year, and the core CPI month-on-month increase hit a low not seen since 2021, significantly easing inflationary pressures. Powell bluntly stated that the policy focus has shifted from controlling inflation to stabilizing employment, and a low-interest rate environment is exactly the stimulant for gold. Remember, after the first rate cut in December 2024, gold prices directly started a $200 US rally. The second code is hidden in the warehouses of central banks around the world. In the first half of 2025, global central banks had a net gold purchase of 493 tons, setting a record high for the same period in history. Goldman Sachs predicts that this buying spree will continue with an average monthly gold purchase of 80 tons this year and at least 70 tons next year. Why are central banks collectively stockpiling gold? Because the US dollar index has fallen 9.2% from its peak last year, and everyone is looking for a safer monetary anchor. The World Gold Council estimates that based on the average reserve ratio of G20 countries, the potential gold purchase volume alone is equivalent to 32% of the global annual output. This force is enough to support gold prices. The third code floats in the cloud of global risks. From drone attacks in Sudan to the US government shutdown crisis, there are more black swan events in 2025 than in previous years. A more obvious signal is in the silver market. London silver's premium soared to 20 cents due to a short squeeze, indicating that funds are frantically flowing into precious metals for safe haven. Data doesn't lie. Every time geopolitical risks escalate, the inflow of gold ETFs surges sharply. In April this year, when gold prices fluctuated 3.2% in a single day, investors instead increased their positions, and the transaction rate on a certain platform still reached 99.98%. This is the power of panic sentiment. But don't just focus on the upside. Danger signals have already appeared. In April, gold prices just broke through $3,480 US and then plummeted to $3,300 US due to profit-taking selling caused by short-term overbought conditions. State Street Bank warns that if the U.S. economy strengthens unexpectedly, gold prices may pull back to the range of $2,200 to $2,600 US. There's another hidden worry. High gold prices are suppressing consumption. Gold prices of brands like Chow Tai Fook have exceeded 1,200 yuan per gram, and the growth rate of jewelry consumption in the Asia-Pacific region is slowing down. When investment demand meets weak consumption, the upward momentum of gold prices will be reduced. Now back to the core question, how much higher can gold prices go? The answer depends on which scenario you believe in. Bull scenario, 30% probability if the Federal Reserve cuts interest rates by 75 basis points within the year, coupled with escalating geopolitical conflicts. Goldman Sachs believes it can reach $4,900 US in 2026, and Incrementum AG even predicts that in extreme cases, it can hit $8,926 US. Neutral scenario, 50% probability. JP Morgan Chase and UBS have more conservative forecasts, believing that gold prices will stabilize around $3,000 US by the end of 2025, as the pace of interest rate cuts may be slower than expected. Bear scenario, 20% probability. Once inflation rebounds and the Federal Reserve pauses interest rate cuts, State Street Bank warns that gold prices may fall back below $2,600 US. Technical analysts have given clearer signals. Looking at the gold sector index, the October resistance level has risen to 26,278 points, 15% higher than September. This means the upside space is still opening up. But in the short term, we need to keep an eye on the key level of $4,370, which is this week's high. If the breakthrough fails, it may pull back to the $4,300 support level. Remember the lesson from April when gold prices deviate too far from the 50-day moving average. It is easy to trigger a technical correction. Currently, gold prices are still $120 away from the moving average, and short-term volatility risks are accumulating. To sum up, gold has not yet peaked, but volatility will increase. The three pillars supporting gold prices: the Federal Reserve's interest rate cuts, central bank gold purchases, and geopolitical risks will not disappear in the short term. So the long-term bullish logic remains unchanged. However, it is cautious to chase the rally above $4,300. A pullback below $4,200 may be a better entry opportunity. For ordinary investors, don't put all your money into gold. The World Gold Council recommends that the proportion of gold in the asset portfolio should be controlled between 10 and 15%. It is a safe haven shield, not a get-rich-quick lottery ticket. Finally, a reminder: Federal Reserve officials will give another speech on October 23rd. Any change in wording regarding interest rate cuts may trigger a sharp fluctuation in gold prices. Paying attention to this timeline is more important than guessing the specific price level. Do you think gold prices can break through $5,000? Leave your prediction in the comments section. Follow me and get real-time market interpretation.